So, hello, good evening, everyone. So I just looked at the wrong area here. Welcome. My name is Simon Misiewicz.
And my name is Louise Misiewicz.
And tonight we are from Optimise Accountants, as we always are, to be honest. But we are answering your questions about tax in relation to not just property, but also business as well. So whilst I'll just do a few technical stuff, why don't you give an précis of the kind of things that you have seen questions from clients, existing clients, when you're doing their tax returns?
Oh, okay. So, well, self-assessment tax season is looming. Delighted that quite a high proportion of our clients have got their data in already. Thank you, everybody. You've done an absolutely sterling job so far. If you're watching and you're one of our clients and has done so already. And if you haven't got your data in, get it in. We can't wait to work on it with you and find ways to save you tax. So some of the things that we're seeing at the moment with regards to self-assessment is all to do with capital gains tax and the fact that this will be the second time that we will be reporting capital gains tax for an individual for the same property sale. What's going on there? Well, that's because, of course, the new capital gains tax regime is in, and I think I've seen some questions already on that tonight.
Yeah, we've definitely got that covered.
So, unfortunately, now you have to file a capital gains tax specific return within a certain number of days, but I'm not going to say how many.
Don't give too much away there, Louise. Don't give too much away.
But then subsequent to that, you also have to report it again in your own personal tax return. So that's something we're seeing as a common theme in this last, I would say, month in particular. The other thing that I'm seeing as a common theme is self-employment and the grants that everybody has secured from HMRC in the last year, or from government, I should say, and making sure that people know how to record those properly in their personal tax returns, because if it's a grant and not a loan, then you have to capture it. And again, there's some very specific things you have to do, boxes you have to tick, and information you have to include in that tax return. So those are probably the two big themes I'm seeing at the moment.
And for anyone watching tonight, obviously, this is a YouTube live session. So please do, I've got my chat box waiting for your questions. So if you are watching us and you want to get your tax question answered, then feel free to pose those questions to myself.
Bring them in.
Bring them in,
them.
as we
say. Want them.
So I will be looking to my left. I'm just wondering where I put my water. We're in Marbella, and we're setting up a temporary studio, as you probably can tell. But I have very little room to actually move my things around. So I've got this bottle of water now, just circumnavigating. I'm not Cristiano Ronaldo. I'm not going to move my bottle of full fat Coke out of the way just to show you that I'm only drinking water.
I love how you brought Cristiano into this.
I know, you got to, haven't you?
Yeah,
far better than Messi. That's a contentious issue, isn't it? Oh gosh, who's better?
In our house.
So what I thought it would do then is basically get your questions answered. I've got a couple of them, so I will be looking to my left. So let's start the questions then. So Afzal, I hope I'm saying this correctly, Afzal, he says, I own buy-to-let property in my sole name, which a lot of people do.
Absolutely.
To invest still. I mean, it's, I know people talk about limited companies is the only way to Essex, or is that a different program? Not sure. But my wife currently does not work, which is really interesting from a tax angle.
It is.
I was told by a firm that doing a deed of trust or deed of assignment can help me assign half of my rental income to her. Mr. Trick, I think, turning to Yoda by mistake there. This would make us more tax efficient as I'm a higher rate taxpayer. The rental income gets paid into a bank account. Is it true? Would HMRC object to this arrangement? Well, actually, Afzal's accountant said 50%. Go on, Louise.
I'd go 99%, quite frankly, as long as that isn't going to push her into a new tax bracket. I'm guessing from what you're saying, if she's not working, perhaps there's not a large amount of income flowing to her name already, or certainly if you were to look at 99% of the rental property profits, if they fall below the basic rate tax bracket, which of course is that magic 50,000. I know it's slightly different from that number, but just rounding it to keep it simple. If you were to give her 99% of that profit every year and it kept her below the £50,000 allowance, then actually, if you're already above that, then that's the bigger opportunity and the bigger win, I would say. But there's, as always with these things, you've got some, serious paperwork to get done. And you've got to follow due process as well. So go take some really strong guidance on how to do that. But that's a great way, and one of the ways that we love to maneuver tax minimization strategies very quickly for our clients.
Yeah, I mean, it's interesting, isn't it, in terms of the whole thing about can I transfer income from my assets to someone else? And one thing that I had a question with HMRC a long time ago was, well, if I wanted income from a bank account to be transferred to a lower basic rate taxpayer instead of a high rate taxpayer, as an example, even HMRC said, well, if you change the bank account details, so it's in that person's name and the money goes into their bank account into the form of interest or dividends, then there's no argument that it's their asset. So why shouldn't they enjoy the spoils, as it were, and therefore get a fairer tax treatment? Yeah. And that came from HMRC. So, anyone coming in whose accountant is a bit worried about that, then that came from the horse's mouth. Not sure you could say. It does begin with a H. Maybe that's what HMRC stands for.
Dear, the jokes are getting bad again already. We're 5 minutes in here.
We're only 5 minutes in. But a deed of trust, interesting enough, I'm not sure if you picked up on mortgages. What things do people need to worry about when it comes to mortgages and lending perspective?
Well, this is why I said due process. So Afzal, we're making some huge assumptions here that there might be a mortgage on the asset. And for those listening in, thinking about doing this as well, jumping on this idea, if you have a mortgage in place, it's really, really important that the responsibility for the debt does not maneuver and move round with the movement of ownership of the asset. And the reason for that is because it can trigger stamp duty land tax. So the person taking on the new debt, if we can call it that, if it hits a trigger point for stamp duty land tax, then unfortunately you could find yourself on the short arm of the SDLT form and the tax due, which is not ideal. And one thing that I will say, and again, it's all about due process and really exploring it for you and your particular situation. Afzal, you've already said it's your spouse, your wife. The good news is when you move assets between a husband and wife, it's about the only wedding present you get from HMRC, but you can move assets without triggering capital gains tax. Sadly, not the same scenario if it isn't spouses transferring assets between themselves. For example, if it's an unmarried couple, or it's a mum to daughter or son to father, anything like that, sadly, not only is it going to potentially trigger stamp duty land tax if you have to move the debt around, it's also going to trigger capital gains tax. So deeds of trust are a fantastic tool in your toolbox, but only for certain situations, for certain groups of people, I'm afraid.
One of the things that on that point is stamp duty land tax. Typically, people talk about stamp duty land tax as a tax charge when you're moving property from one person to another. There's also the 3% SDLT, and the 3% SDLT, I think we need to remind ourselves, I'm holding my hands up like I'm a Tyrannosaurus Rex, about to pounce. That's not true. I'm just leaning over this glass table, not trying to make a mess of it. But the 3% SDLT high rate really applies for when you're buying a property. I don't really often see it when you are moving properties from one spouse to another. And there's legislation about that, actually. HMRC even themselves have brought in about 2 or 3 examples, whereby if you do a deed of trust, there's no 3% SDLT. But we're seeing countless number of solicitors. I'm not having a pop at solicitors, but they are costing you thousands of pounds in errors of just assumption that they should charge you 3%, but they shouldn't, should they?
No, they shouldn't. The 3% doesn't apply, and it's categorically confirmed as it doesn't apply in the legislation to scenarios where you are moving assets simply between spouses.
Which is a real shame.
You heard it here, folks.
Yeah. And we see it a lot, not just in our own clients, but we see it often in terms of people making paid for tax calls to us to say, look, how do we stop this? Because my solicitors are not listening. Yes. We typically say, look, you have to remember that like accountants in different firms or solicitors, they use juniors. So they are, I don't want to sound really negative, but sometimes they can be a bit box ticking. And as a result of that, they don't understand the form. So they try and apply the 3% SDLT high rate. by not really asking great questions. So I think, you do need to challenge them on that, or better still, just use a solicitor who is a property tax specialist. And it's a kind of perversity, because a conveyancing solicitor is a property lawyer, really, solicitor.
But not everybody does the kinds of things that perhaps our clients are doing, and perhaps you're doing. We saved a client on a paid one-off tax call. We saved them over £15,000 this week, just because of that one issue. The solicitor in question had wrongly assessed that the 3% was due. It was not. We were able to point out the legislation, £15,000 saved immediately.
Yeah, and that's really unfortunate, because I think it puts the client really under pressure. This was a one-off call, as Louise mentioned, and they paid for our time. But did they really need to pay for our time to get that answer when the solicitor should really have answered that? I'm not sure.
It's a toughie. It's a toughie. But
you know what?
If we're giving people like yourselves the comfort that actually the process they're following is correct, and they're getting every single tax saving they can that's on the table ready for them, fantastic. If we can do that for you, we'd love to.
Yeah, absolutely. Totally true. Peter Johnson. So if you're
Peter.
Hi, Peter. Peter says, I own 10 properties in my own name. I also own a limited company that owns 4, which again is a standard thing that we're seeing more and more, that people see in their own names. I wish to close the company down via members' voluntary liquidation. Interesting. I would sell 2 of the properties, transfer 2 via a ex-specie dividend. Well, we'll talk about that in a minute. And then the insolvency practitioner would keep enough cash in the company to pay the corporation tax on the capital gain. My accountant says, though, it says this is a small chance it would be targeted by the anti-avoidance rules brought out in 2016, as it still will be a letting property. He said there are rules were not designed to catch me, but they could do so, basically. And interesting enough, what we do an awful lot of learning ourselves. And I remember we're part of the Chartered Institute of Taxation, as well as the Chartered Accountancy as well board. And both do very good events, CIOT more, or the Chartered Institute of Taxation. And there's one particular event where they talked about this very thing. I don't know if you recall, Louise, whereby he said that any distribution via capital of the shareholding, where the company either buys your shares off you or liquidates in a certain fashion, to use this phrase, which is the ex-specie dividend, will be seen as a distribution, not as a capital distribution. And HMRC have indeed, I'm not sure the year, so this 2016, maybe more information than I even know, but I certainly know that the person that we was watching pretty much said, don't try this at home, kids, you will get caught out. It's
basically targeted anti-avoidance rules, so something called TAR, and it's also referred to as well as anti-phoenixing. So what it is HMRC are saying, if you close down a company and within 2 years do something same or similar, in a either different company or in your personal name, then they will classify the prior closure of the limited company as exactly as Simon said. It is not a capital gain. Instead, it's considered income. Now, what's the real difference? It's cash in your pocket. You're going to get taxed. If it's taxed under capital gains tax, it's likely to be taxed at either 10 or 20%, depending upon whether you can benefit from a really fantastic relief called business asset disposal relief. And that drops it to 10%. Otherwise, it's likely to be 20%. Conversely, if it's classified as income, which this piece of legislation focuses on, kiss goodbye to up to 45% of that money as tax. Now, which one would you prefer to pay, 10% or 45%?
There is a couple of things that was interesting on that point, because I think what Peter was saying was he's looking to close down the company. And if we break this down, if you've got properties that you have sold, which has then got capital gains tax, and then you want to transfer over, to be honest, this dividend specie may be caught out via income tax rules anyway. If you are closing it down and you have got money left in the bank account, then you would close it down. And as Louise said, you would have this, you wouldn't get better, because BADA is related to trade companies.
Yes.
And if yours is property investments, then you're not going to get this business asset disposal relief. Anyone listening in thinking, what the hell are they talking about BADA for? BADA is a replacement to entrepreneurs relief. So if we just mention entrepreneurs relief, because most people will relate to that, but maybe not BADA, albeit BADA does sound a bit more interesting.
It's a more appropriate definition, that's for sure.
Yeah, it is. So I think in terms of the whole closing down of the company, you can certainly do what you talked about, whereby you've got money left over in the company sells the assets and then transfers the money, but it's not a dividend. It's just a distribution of your capital because you've sold your shares back to the company and then the company closes down. But the one thing I would say about all of that is if your cash left in the company is more than £25,000, then you'll have to go through an insolvency practitioner. And they're not cheap.
Is what Peter's talking about anyway, isn't he? He's talking about a voluntary liquidation, which
will
most likely involve a practitioner.
But the thing is, they're not cheap.
No,
so a practitioner of insolvency is a very niche industry. So you could be paying, the last time I got a quote, not for myself, but someone else, was £14,000. And that was for a very basic, similar to Peter's scenario. So do be careful when we're talking about liquidations and you've got lots of money in there, because one of the ways around that, and it's something that we advise our clients, is just to take your dividends out. And then when it's less than £25,000, then close the company. So you might have to keep your company open for a couple of years more, but is it worth it?
Well, and this is the question I think, Peter, you might want to just ask yourself. If you were to trickle feed the money out of the company in the form of perhaps salary and dividends over time, then, literally waste away the money carefully taken with tax efficiency in mind into your personal name, rather than go through a members voluntary liquidation, I wonder whether that might work better for you and might give you more tax savings. We've looked at this now multiple times for clients. It's a very rare beast that actually works out better value for money for them to go through, if you like, a practitioner to help them close down that company. And it's much better to, as I say, my phraseology, trickle feed the money out as carefully as you can with tax efficiency in mind until there's nothing left, and then close the company.
Well, before we kind of get into detail, because Peter's online. So Peter.
Hey, Peter. Hey, excellent.
And for anyone listening in, if anyone's thinking, hey, are you faking this? Is this really live? It really is, because Peter's just answering those questions. So he's basically said 4 flats in their company, 10 flats are in my name. It's in my name. It's in the garden. He's stealing my properties. Here he goes again. 10 flats in my own name. Wish to enter an MVL, which I think we've covered off now. But then he says, thank you for replying. My accountant said one thing is to change the trade of the company to, say, holiday lettings. No. If it's been investment all the way through, then trying to change it just to get some sort of tax release, that's a definitely no.
And you might find yourself kicked in the foot as well if that message gets out and you're in a location that doesn't allow holiday lets, London, then you could find yourself on the big end of a very painful fine.
Yeah, interesting enough, Peter's been quoted £5,000. I think that's pretty cheap, to be honest. When you saw that price, you probably thought that was expensive. Rest assured it's not, but yes, it is the cheapest. Just be a bit careful with cheap. I see this a lot. Solicitors will question, but if you use someone pretty cheap, how good is their quality service? And actually, what guarantees do they give it's right as well? Like, really, what you're doing here, make sure that you check out their qualifications, credentials, their experiences, check them on Google reviews, do all that kind of due diligence on them.
HMRC have a list of live organisations that are capable of doing this. I'm sure you've already checked all of that. What Simon and I have found over time, and I'm very mindful we're jumping on the phrase cheapest. So Peter, this might not be the case for you,
no.
But sometimes what we find is the individuals who present the cheapest price actually don't tell you about all the add-ons. And then subsequently, when you've worked out all the additional add-ons at the end of the process, it's more expensive than the more expensive one that you kind of said, no, it's too expensive. So I'm sure we're telling you stuff you already know, but just thought we'd share that as well.
Yeah, no, it's absolutely worth it.
And thanks for being online and being able to talk to us about it.
Yeah,
it's great.
Always helpful. I think when you've got questions, you throw them out there. You can watch this, obviously, in due course, but sometimes it's easier when you're online. Pradeepan, I should get that right. Pradipan. Okay, yeah. It says, will there be any stamp duty when the property is transferred from an individual to a limited company? Interesting. If there's any outstanding mortgages, also, if someone is having several properties, can they transfer it into a limited company and claim incorporation relief? Now, that's two big subjects. Okay, so let's just talk about transferring one property. And let's imagine, Louise, there's let's imagine transferring two properties. One of them is below 500,000 and one is above 500,000 because there are a special tax. Now you're thinking about this. So the first one is the standard. So let's imagine it's £400,000. What stamp duty land tax would you pay by moving it to a limited company, please?
Well, you're going to pay the normal, and I say normal, I wish it wasn't, the normal stamp duty land tax rates that all of us pay when we buy, say, a home, but you're also going to pay the higher rate, which is the 3%. And unfortunately, if any member of the limited company is classified as foreign, and I'm not going to jump into the detail of what foreign actually means, then you might find yourself on the sharp end of an additional 2%. So you just need to be careful when you're looking at moving an asset, because of course, stamp duty land tax is payable within 14 days post completion. So you haven't got a lot of time to amass the cash. And if you haven't realised how much cash you need, you could be in a little bit of hot water, to say the least. I think there is one question just to come back to is stamp duty land tax payable? Typically, if you look at HMRC's website, they've got a fantastic section on this, and they describe that if what you're getting in recompense is the shares in the company, then that is consideration, money's worth, and that is what the stamp duty land tax will be based on. So I'm afraid simply gifting an asset to a limited company in which you obviously have the shares, you're not going to get out of the stamp duty land tax, sadly.
And there is also an aspect of the £500,000.
In terms of if you're buying it to reside in, as opposed to, is that what you mean?
Well, here
you talk about the ATED.
So, well, I'm just thinking about the £500,000 charge. So I'm just going to read this out from HMRC's material here. So for properties over £500,000, HMRC, quite rightly, and I just want to do this word for word because I think we've got to be careful when we talk about online. And it's live. One word could mean something completely different. But it says here, stamp duty land tax is charged at 15% on residential properties costing more than £500,000. And we had a client, funny enough, who bought a property, lived in the property, wasn't aware that you'd have to pay 15%. So you do need to be careful on this. It might not be applicable to you, but I think people listening into this, it might be. So finishing off, it says here, bought by certain corporate bodies or a non-natural persons, whatever that means. Basically, it does say these include companies, partnerships, including partnerships, collective investment schemes. And there's the things like ATED, which we're not going to go into too much detail now. But one thing it does say is that the 15% does not apply to the property above the £500,000 by a company that is acting as a trustee or settlement, or bought by a company which is then used for, and it's got a list here. So if you can picture the bullet points in your mind, that'd be useful. So a property rental business, a property developers trader, property made available to the public, interesting, financial institutions acquiring property in the course of lending, and a couple of other things, including farmhouses. The interesting thing is here, it is very much specifically looking at people buying a home in a limited company, which they then live in. So that's what the 15% SDLT charge is all about. So I don't think it's necessarily to your kind of question, but I think it's worth advising on that, because we had a client who bought a property into a limited company, didn't say what it was used for, just said, I'm buying a property in a limited company, and then moved in. And then the conveyancing solicitor said, well, actually, I'm going to have to charge you 15%. And they weren't aware of it at all, but we weren't even aware that I was going to live in it. So really interesting about how that came about, but you do need to be a bit careful with that.
You do.
Let's talk about incorporation relief.
Oh, my goodness.
Again.
We're getting some really great questions again.
I mean, we kind of talk about this process whereby people talk about, using smart companies. And we work with Property 118, Mark Alexander. Hey, if you're listening, they do a fabulous job of moving people that need a limited company in a company structure. They do all the kind of incorporations. We work with them to do that. But the one thing I would say is that you can get so many reliefs like CGT, stamp duty, land tax. Stamp duty, land tax is a mitigation through the incorporation relief, so you certainly can get that. But what I want to bring people's attention to, and it's tripped a few people up actually, is capital gains tax. We did some internal training about this to say, well, what really does happen? So if you've got a market value of your properties, let's say it's £1 million, and then and it was originally purchased for £500,000. So market value compared to the original purchase price is £500,000. Ordinarily, if you sold those properties, you would have a capital gains tax on that £500,000. But because you're using this incorporation relief, then it's deferring CGT. Please do know that word defer. It's not mitigation, it's deferral. So that £500,000 gain will crystallize if you eventually sell the company on. And I think some people aren't aware of that, because I think they're saying, well, I want to incorporate, get all the benefits, and then ditch the company in a few years' time. And if that's the case, then it's not really right for you. So I would say, before you go on the merry-go-round of incorporation of your properties, ask yourself the kind of key question is it really right for me? Should I do it? Given that there could be extra finance costs, there could be accountancy fees, there'll be other professional fees as well, conveyancing fees as well. And then will you do it if it's really right for you anyway? Because we do see people that we say incorporation is right for them, and then they're told it's £30,000 and think, oh, I don't be paying £30,000, grumbling about it, which I appreciate is a lot of money. But if it's saving you £100,000, I do see people kind of sit on the fence and then don't do anything for 5 years, then totally regret it.
The one thing I was going to add actually is there's a very nasty twist in the tail, and it's called latent gain. And I'm not going to go into a lot of detail on this, because otherwise, I mean, we could be here all night on this topic. It's such a great one. But there is a scenario where, even though you are mitigating and delaying certain taxes like capital gains tax and stamp duty, land tax, if you're able to follow incorporation relief, if you happen to have a sizable amount of debt against the portfolio, and that debt now exceeds the original purchase price of the assets when you first bought them, woe betide you doing incorporation relief, because you're going to be on the sharp end of a capital gains tax bill immediately on incorporation. Maybe not for all of the value, but the moment your debt is bigger than the original purchase price of your portfolio, when you add it all together, I'm afraid you're going to still pick up capital gains tax pretty much immediately to incorporation. And that can put people off. Sadly, I've come across a couple of scenarios where, not necessarily 118, but I've come across a couple of scenarios where clients were completely unaware of that and had massive, massive capital gains tax bills that we were just able to stop before they'd taken that one step that would have been too far to backtrack from. So just be mindful, it doesn't necessarily resolve all the pains.
I do want to bring that to life, because we had a situation similar to what you just said, whereby they, and I'm going to create a video of this, a short video of this, of why the buy, refurb, refinance strategy can harm your incorporation. Let's go for an example here, but imagine that you bought a property for £100,000, you did it up, and then it's now worth 200,000, and you remortgage it at 150,000. Well, when you come to incorporation, you like Louise says, you stung yourself, because the difference between the £150,000 mortgage, which you refinanced, and the £100,000 purchase price of the original property, well, that is going to be causing you a latent gain. So you could have a 28% tax bill on that £50,000. And if that's been your strategy, and I know on YouTube it's very popular about buy, refurb, refinance. There's so many people. I mean, even Kevin Wright, who's such a great guy, he talks about it as well. And it's a good strategy, but it can sting you when it comes to incorporation, because you've now got this huge latent gain, which no one talks about. So it's often, yes, you can get all these reliefs, the incorporation relief, a CGT, which again is deferral, not mitigation. You get the mitigation of stamp duty land tax, but bang, you've got the capital gains tax latent gain. And we've had a couple of clients who have just said, well, how do we finance that? Because it's a personal gain, which you personally have to pay for it. You've moved all your properties to a limited company. Your company can refinance it, but then, well, how do you get the money out? You're going to have to extract that. So the buy, refurb, refinance strategy for incorporation, which I will create a video for that, isn't always the best thing.
And isn't it always the case? There are so many fantastic property strategies out there. Some of them naturally go together beautifully. Some of them do not.
Pradipan has said, I've said the word, your name correctly this time, but Pradipan has asked about the deed of trust and said, can HMRC challenge it? Interesting enough, on the deed of trust, and I might have to cobble this together in terms of the video, creating a short video maybe for this, but it is a fair challenge, because if you've got a property that is either 100% yours or 50-50 between you and your wife, and now you're moving it to someone else, albeit I gave that example earlier that HMRC themselves told me if you've got some assets, then to split that into that person's name, and then that'd be fair because it's representation. But when it comes to property, it's a little bit more contentious. So what I often say is, well, if you've got someone that is earning 99% of the property income, then the deed of trust must state that the property income goes there. So does the capital, which is something that people really aren't aware of. They just think it's the income, but it's actually the beneficiary interest of the property, which means capital as well as income. So you do need to bear that in mind. And then people's thinking, oh, what happens if we get divorced? I'll let you think that one through. But in terms of that, I think you need to demonstrate that it's in the person's bank account. So rather than it going to a joint bank account, often say to people, if it's predominantly going to one person in a married couple situation, maybe it's worth setting up a separate bank account and then they spend the money as they want. And then HMRC haven't really got a problem with that. And again, to be honest, a lot of my tax tips aren't mine. They are because I have sensible conversations with HMRC to say, what do we do and how do we safeguard it from an investigation? And they can be very, very useful. And so hopefully that's useful. Anything to add on to that?
The only thing I just noticed is Pradipan's asked, can the Form 17 be used by any joint tenants, or does it have to be a married couple? So the Form 17 is a document that allows you to tell HMRC about a change in ownership of the underlying asset as well as then the income. It's used in particular scenarios, so it's not specific to, let's say, a spousal relationship. It's more specific to how the asset was first owned and how it's now changing ownership. So don't get caught up in it needing to be a spousal document. The Form 17 is more, well, we're changing the ownership from what was 50-50 to something different, and that's how you use it, and that's when you use it to tell HMRC.
Yeah.
And there's a very tight timescale as well to tell them. So you have to do it within 60 calendar days of the executed deed that you're using, or the assignment document.
Yeah, so that brings me to an interesting one, because we had another pay-for client call who did a deed of trust, and they said, my accountant's not allocating the income in accordance to this deed trust. And I said, oh, that's interesting. Well, tell me more about it. And this deed of trust was done in the year like 2000, but they didn't do it. So the property was 50-50. And if you do it 50-50, you have to do this Form 17, which is just a document that goes to HMRC to say we're doing something, a split of income that is not going to be 50-50. It's going to be 99-1 as an example. But they didn't do it. They just did the deed of trust. They didn't do the Form 17. So they didn't notify. And unfortunately, that was nil and void, because HMRC will say, look, you've not notified us within 60 days, therefore we won't allow it.
They won't backdate.
Yeah.
They won't backdate.
Just an interesting point about this. Louise, a pop quiz for tonight, because, you know, it's interesting to do that. What's a property when it's owned 50-50 called?
Well, you have tenants in common.
Yes, you do.
And you have joint tenants.
Right. So tenants in common and joint tenants. Joint tenants is where you have a property 50-50. Now, if you have a will, well, actually, it doesn't matter if you have a will. A joint tenant is where you own it 50-50. And if one partner dies, it naturally goes to the other partner. But what was really interesting, we did a deed of trust. And what happens with that? It comes tenants in common. So tenants in common, really important factor here. Why? Because it doesn't naturally go to the other spouse. So if you die, you own 99% of the property or 1%, and you hope it goes to your spouse. It doesn't naturally do that. Actually, in law, it basically reverts back to the will. And guess what? This particular person didn't have a will. So it's really important, if you're doing anything like this, is to make sure that your will is up to date and you add your property like this to your will.
I bang on about checking your will once every 18 months to make sure it's still complying with everything that is A, your wishes, and B, your current asset base, because things can change quite dramatically in 18 months. So sorry, I'm getting on my high horse again. If it's been 18 months or longer since you last looked at your will, look at your will.
Yeah, so it's so interesting. I think just anyone listening in, Tim Bishop, who does a lot of our legal stuff, as well as Natalie as well from Galdards, both of them would say that you need to regularly update your will whenever you have a life-changing event, marriage, children, divorce, moving country, that kind of thing should trigger you to think about getting a will. So just as a bit of a nip it in the bud there. We're already halfway in our show. Yeah,
we can't be halfway already.
It's amazing how quick these kind of events. I always think that there's not enough questions, and yet here we are. So if you do have any questions, make sure you fire them in, because Louise and I are absolutely delighted to pick them up. Just to it's kind of buzz in here as well. Louise is going to be driving one of her own live events. I'm going to be here just for the technical, and I'll chip in as on certain stuff.
Because you can't keep quiet.
I can't keep quiet. I love the sound of my own voice. But Louise wants to talk about self-assessment tax returns, and anyone who's looking to do a self-assessment tax return, you might want to do it yourself. That's fair enough. But you still might have questions about how to submit it, or you might have questions about some element of your tax return. And Louise, it's going to be her show. So that would be really interesting. Looking forward to that.
I love self-assessments. Well, I don't love self-assessments because I don't like having my clients pay tax, but I love self-assessments because there's so many opportunities to save tax. And I'm not even going to bore you to death with how many thousand tax returns I've personally filed. But there's a lot of opportunities with the self-assessment. So I'm going to be running some sessions on that because I think it will be hugely advantageous. And if you'd be interested in that, well, stick around and find out when we're going to do the first one. Yeah, well, hopefully those are all gone live as well throughout various social media. But just check out our website, www.optimiseaccountants.co.uk. Go to our live seminars, and you'll see it there. So make sure there's a couple of them coming up next week as well. Moving on, M. Howard has asked a question: do I need to keep a separate bank account for my property business? Interesting. Lovely question. Why don't you take the one by the scruff of the neck? Well, for me, the answer is absolutely categorically, positively yes. Have a separate bank account, because you should be keeping receipts and documents to do with that business for approximately anything to do with property business for approximately 7 years after the tax year ends. There's a slightly different number that you're supposed to keep it for. I say 7 because it's easy to remember, and that way you're never going to fall foul of not having the right documentation. If you're running it in a bank account that's clouded and busy with lots of other types of income, might be self-employment income, might be salaried money coming through the door, might be a whole host of other things, then if you do need to do a review of that, or rather HMRC require you to do a review of that, it's going to be really hard to keep it very clean and very easy to make sure that there are strong auditable connections with the income and the expenses flowing from that bank account specific to your property business. I also think it demonstrates a real commitment to the business. I absolutely get it. Sometimes we all start up a business or an activity very entrepreneurially, and we work with what we have, with the materials we have to hand. And that sometimes means using a bank account, but as fast as you can, separate out your bank account for your business. And each separate business and I'm saying business, not property, each separate business should have its own bank account. So for example, if you're running furnished holiday lets meeting help sheet 253 conditions, won't bore you with that tonight, have that completely independent of the bank account running your residential properties that don't meet help sheet 253 conditions. Keep things in separate silos because it will really help you. I'm off my bandwagon.
No, I
keep getting on it tonight.
It's an interesting one because I always say to people when people say, should I use a business bank account or a personal? And back to your point of HMRC investigations, they can open up all sorts of questions about your personal transactions, and you don't want that.
No.
But the big thing for me is if you've got a business bank account and it's constantly growing, Louise, let's pose that question because I think it's easier to do it this way.
Sure.
If a bank account is growing, are you making money or are you making a loss?
I would say you're making money.
And that's because
if there's more money in the bank account at the end of every month, and the only thing in there is your property business, well, that's got to either mean one of two things. Either you're not paying your due, or you genuinely are making more money every month. Yeah.
So I think these are natural things for you to kind of think about that, for sure. So that's a great question. David Tins has said, if you have a limited company if a limited company has losses, can you still take dividends?
Wonderful question.
So great question, David. I think in terms of a limited company can only distribute dividends if it has retained profits, which means that the income must be greater than the costs, and therefore you've got profit to distribute to the shareholders. Otherwise, it's a loan because you might have to fund it somewhere to give the money back to you, which it can't be a distribution of income. It has to be some other form of distribution. It could be seen as income of wages. I mean, it's possible to take wages out of a loss-making company and get funding from a bank to fund those wages. I wouldn't recommend it. I mean, if your business is struggling, why would you make it worse?
Can I add to that though?
Yeah, please do.
Because I'm looking at it from a slightly different angle, David. So forgive me if I'm going completely off where you're coming from. If you've made a loss in the most recent year, but actually when you look at all of the retained profits you made in prior years that you've not yet taken out, and when you net that loss against those profits, if you've still made a profit, you can still take a dividend. If, however, your losses far outweigh all of the retained profits that you've got in your business, I'm afraid there isn't an ability to take a dividend.
Very true.
Top level.
Yeah.
There's a lot more detail we could jump into because there are a couple of scenarios where you could take a dividend. We only just talked about them this week, funny enough, with the tax team.
Yeah.
But they're not cast iron, and my concern is that HMRC sometimes jumps all over them and can pull them apart. But that's broadly how it works.
No, great answer. Nothing to add there. HA has said, what happens to a property that has been placed into a trust for a child? That's a huge question, isn't it?
Oh, what a fantastic question. That's like an exam question.
I mean, where do you start that? Yeah, it is like an exam question. I think, where do you start? Because I think why is a property
Which trust? What kind of trust?
Yeah, bare trust, discretion trust, in possession trust.
Vulnerable child trust.
Yeah, it's not an easy one to answer.
Fabulous.
I think, to be honest, I think in terms of HA, if you're watching into this, is because this subject can easily go on to lots of areas. I think if you come on the show next time around, maybe ask a real specific question if you want to. I appreciate it might be a bit sensitive, but it can really have an impact on what we advise.
What an amazing topic, trusts on their own right. I mean, I think we could run an entire series on trusts. You know, for those in the know, the Duke of Devonshire, the late Duke of Devonshire, pretty much passed on something like £18 billion worth of assets a few years ago to the new Duke of Devonshire and paid not one jot of inheritance tax, courtesy in the main from trusts and using trusts very carefully. They were a fantastic tax saving tool up until about 1992, and then the laws changed a little and made it much more expensive, but in certain circumstances it's still a fantastic tool in your toolbox.
I'm going to go to the YouTube Live. If you are watching on YouTube Live, LinkedIn, or anything like that, please do get your questions into us. We want to take those questions.
Absolutely.
It makes our show a lot more interesting for us, and it's going to give you benefits.
Yes.
So why not ask that question? Get it asking. Matthew Herbert has asked a question. I'm kind of treading on eggshells here because
Yes.
It says, is class M1 building class likely to come to Scotland? Not fair, England can do conversions.
Forgive me, because I'm not up on my building class terminology.
Neither
Is
am I.
this to do with the permitted development rights to changing office blocks to residential? Is that what you mean? Simon's now Googling like
I am,
mad.
because I don't understand it. M1 class building, let's just put building.
Motorcycle licenses, I don't think that's what.
Yeah, it's definitely not motorcycle, is it? And there's nothing on there. So I guess we don't know. It's if even M1 has got low emissions. So
I don't think you're right.
I don't think we're on for that. So sorry about that.
I'm so sorry about that.
If you can come back to the show next time and give us a specific on that one.
Then
In fact,
we're
you
delighted.
are obviously on YouTube Live, so maybe give us a bit of an example.
Yeah, if you're still here with us, tell us more. Tell us more. Did I get that right? Was it to do with the? It probably wasn't. But
Yeah,
to do with the office.
It'd be quite funny if it was totally not.
Yeah, probably to do with emissions.
Okay, so Kishore has said, "Hi, could a foreign investor?" Interesting. I love that. I mean, we're doing an awful lot of international tax planning.
We are.
And this is my soapbox now.
Oh gosh, here we
Okay,
go.
this is my soapbox.
We'll be here for about 10 minutes though with Simon.
So we're talking about international tax planning, and when you go to a UK accountant, what they basically mean is you're a foreigner, so I'm going to tell you everything to do with the UK tax. Okay. Then you go to America and you say, well, I need to know international tax, and that CPA will just tell you everything about American tax. And you kind of think, well, hold on, are you giving me transatlantic tax? Are you giving me international tax advice? No, they're not. They just see you. They say it's international tax. What they mean is you're coming from a foreign country into our country, so we'll still tell you about all of the taxes in our country.
So true.
So annoying. Okay, so just be careful of that, because whatever you do in one country and move to a different country, you've got not just to be tax efficient in the country you're leaving, you've got to be tax efficient in the country you're going to. You've also got to be tax efficient across the waters. And if that sounds quite difficult to get your hand around, it is. But it's so important for you to understand true tax treaties across two countries and where you could trip up. I mean,
I'm smiling, but with pain in my eyes.
We've paid for this advice personally, haven't we? So we know that. So then we ended up telling them what their own tax regimes is. It's just ridiculous.
Yeah. Moving on. Before he gets on his next soapbox.
Easy done. So next one. Ourselves has said, I own buy-to-let property in my own name. So this is the person.
Come back to Kishore.
What's that? What? Oh, sorry.
Sorry, Kishore.
Oh,
could a foreign investor buy a buy-to-let property in the UK?
Do they get the 12,500 annual tax-free income as a UK resident when it is bought in a limited company? And that's an interesting one. Part of the international tax in the UK, we've got something called the remittance basis, which basically means that you say to HMRC, I want you just to tax me on my UK income. And if you say that to them, you lose your personal allowance. If you say to them, actually, do you know what? You can tax me on my worldwide income. That's all right. You then get that 12,500 personal allowance. So sometimes it can work for you, but it can also work against you.
And this is also assuming that you are resident in the UK. If you're not resident in the UK and you don't fall within a certain criteria, then you won't get the UK personal income tax allowance of £12,500 as it is currently. So there's a lot in that question, Kishore, which I feel like we're now going round slightly, but actually it's a real big topic.
It does say UK resident though, so I think we can only go on that basis.
Perfect.
So I think from that side of things you would do, it's really worth you thinking about a number of factors, because after a while, we had a client who I said, well, why don't you just bugger off to Portugal for inheritance tax? And you're thinking, well, what's going on? I did. YouTube have banned me now, won't they? But they probably don't know what that word means. So I think from that side of things, I would say that you do need to get some tax advice around that, simply because the country you're leaving is you're going to have exit charges. You're going to have entry charges in the UK, and when you should do certain stuff would dictate on everything you do. So make sure you have a conversation with someone. YouTube is great. And I always say that with this kind of thing is this channel, the videos we put out there is here to give you what I would call the golden nuggets for you to speak to your advisors about. Okay, it's not the be all and end all. It won't give you the specifics, but it will give you that something you don't know what you don't know. Hopefully these videos gives you that bit more to go away and get some professional advice, is all I'm going to say on that. We are coming to a close now. We've got 10 minutes. We've still got 10 minutes, so we've got 10 minutes. Halcyon Leon, that's an interesting phrase on YouTube catchment. But Halcyon Leon says, how can two people that are shareholders take different amounts of money from the limited company?
Awesome question. Awesome question. Can they take different amounts of money?
I'm going to say no. And I'll tell you the reason why. I'm going to just put it out there. If you've got two directors that set up a limited company all by themselves on this pay peanuts, get monkeys site called Companies Formation. By the way, not having to dig at that company, but it's cheap and you get a cheap product. But two people setting a limited company who have 50 shares each, what classification of shares will Company Formation give them?
Well, if you're not careful and you don't know what you're doing, you'll end up with ordinary shares, which all sounds fantastic, but it's quite
restrictive.
Ordinary. Sorry, I had to do the pun.
That was pretty bad.
Yeah, well, it's your level, I know.
Oh, that's shocking.
But unfortunately, if you're all in the same share class, if I can only put my teeth in, then I'm afraid you can only take dividends in the proportion of shares that you own. So if you have 50-50 shares, you must take 50-50 dividends. If one of you doesn't wish to take dividends, be very careful, because that realistically means in most scenarios, no one takes dividends. So you've either got to both agree, or you've got to agree, basically. You either take them or you don't take them. And it's both of you that has to take them.
I mean, there is a way around it.
No, is there?
Yeah. What can you tell me about share for share exchange? Because you love those. Yeah. It's what you do all day.
Oh, so if you happen to have two different share classes because you've got two different shareholders, like an A share and a B share, I know I'm really pushing the boat out on the names here. I'm so sorry. And they're both still ordinary shares. All of a sudden, you've severed the link between the two of you needing to both take dividends, or indeed both of you take the same dividends, even if you both own 50-50 of the company. So if you are careful and think about your share structure before you set up your company, then there is a great opportunity to take out different types of dividends from one another. That doesn't take away the fact you both got to agree to it, obviously, but it's a great opportunity to be more flexible and more forward thinking, particularly around tax mitigation, but also around taking back what's due. Yeah,
you do need to be careful though, because I've been party of a conversation with someone whereby there's two parties involved in the company. They're not married or a spouse or anything like that. And they said, what if we have this person take more dividends out because they're a basic rate taxpayer, and I take less because I'm a high rate taxpayer? And so like, it just sounds as though the tax tail's wagging the
business job,
the business body of the dog. It just didn't make sense. And I said, well, have you thought about what you're talking about? You're on about giving more of the money to the basic rate taxpayer just because they're a basic rate taxpayer, but you're actually physically giving them cash. Are you happy with this? And the high rate taxpayer said, do you know what? I've not thought of it like that. I've just been thinking that there's a tax problem. So you do need to be a bit careful of solving a tax problem, but causing yourself a financial problem because you're thinking, well, I've just actually given my assets away to someone that we're meant to be in business doing 50-50 on. So you do have to be a bit careful, I would say, on that point. But great question.
Lovely question.
I've just noticed there's a couple of questions about family investment companies. I'm going to sway off that one. I know that Bob Welton's asked a question. And the reason for that is because I think we spoke about that with share structures and to be honest, to answer very quickly, but a family investment company,
you knew he wasn't going to be able to leave
it's just a shares with different share classes. So you've got just people with shares. So
and those
husband,
people
wife,
happen to
kids,
be related,
right?
And they might have a very specific shareholders agreement in place that explains what happens with their shares.
Yeah, so I don't think I'm going to go too much into that. What I do like, because I've just read some of the other ones in terms of CGT, I think we've already answered those. But there is a great question, and it does lead itself into everything we're doing and focusing on.
I think I know where you're going.
So Samantha said, is it possible to be tax exiled? First of all, for anyone listening into this, what does it mean to be tax exiled, Louise?
Well, it doesn't mean you're on the run. That's the first thing. What it does mean, though, is that you have found yourself to be in a very unique position amongst very few people who, quite frankly, don't really pay any or very much tax to any government or organisation. I'll leave it like that.
Yeah, and the way you do that is to be, like I say, non-resident in any country in any given year. So it's possible for you to do this with, typically, I would say it's easier to do with 3 countries, but better with 4 or 5 countries if you can do it. And
who doesn't want a country hop on that level of basis?
Yeah, I know a few people who do it. I'm not going to say the names because they probably don't want to share that information out, but they do that. You know, they go to different countries. So it is possible to go to Portugal, Spain, France, UK, and America as an example, and then have homes across those countries. And then just say, do you know what? All the income is mine, not going to pay you any income tax because I'm not resident in those countries. You do need to be a bit careful, though, Samantha, where you generate an income, it could be taxed there, but you wouldn't be taxed on your worldwide income, which is where the pain can really come in. So if you've got investments, then sometimes like the UK, they will say, well, actually, we want to do a withholding tax. And then you do tax return based on the income generated in that country. So it's not all plain sailing, to be honest, but you know, if you're getting a wage from your limited company per se, then would you be taxed in any country? I think there's genuine good reasons of situating yourself in a tax efficient country or countries and not pay any tax. So the question over to you guys is, if you're watching this channel, would you check your self-assessment tax returns? I think that's the best thing, or your wage slips, and say, well, actually, how much tax do I pay? And could I not utilize that money to have a renegade lifestyle, which it means I'm going to be dusting myself around different countries? And who's that person who worked at KKR and he lived on a boat? Was it what guy from KKR? Or Abramovich?
Probably Abramovich.
But what you'll hear stories that billionaires will have
moored slightly out of maritime locations,
100 meters outside that's not just tax jurisdiction, but obviously that country's jurisdiction, just to avoid tax. But then why wouldn't you do that? So basically, what's more interesting is that most countries would run on a nightly basis, don't they, Louise?
Well, in the UK, you're considered resident based on how many midnights you spend in the UK. In the likes of America, it's not midnights, it's how many physical days you've been in the country. So if you've only spent an hour in the country on a particular day because you happen to land there and move on, that's still classified as a day.
But not transit. No, not on transit.
In certain circumstances, transit is completely ignored.
Yeah. So all these are things, and COVID as well, has been forced to stay in the country.
Extension, not a lot.
Yeah, but to end this show on, can you be tax exile? Can you pay 0% income tax? We are proud to say, we're not proud, it's not us, but it's not us bringing you a product that we're selling.
Ta-da!
Yeah, bang out. It's not like that at all. But it is entirely possible to live in different countries and not pay any income tax at all. So perfect.
How dreadful.
So that lends us to a close. There are a couple of events that's coming up. So next Monday, do we have anything? I don't think we do. The 30th, we have on the 26th.
Yes.
So 26th, funny enough, if you're from Hong Kong listening to this, we do have our HK to UK session coming up. And that's Thursday, the 26th of August at 3:30 p.m. because we want to make sure we get the right time for Hong Kongers because they're far more hours than we are. And then it's back to the Property Expert panel on
Hooray!
the 6th of September. So
It's only been away a month and I've really missed it.
Yeah, it's been a bit of a loss for me. And then we're back to the self-assessment. So Louise's first self-assessment show will be Monday, the 13th of September at 8 p.m.
Lucky for some.
And then it's back to us again on the third Wednesday, I think it's going to be, fourth maybe, when we do this business
Come
and
join
property
us
tax again.
Don't miss us.
No. So thank you ever so much for joining us tonight. Hope wherever you are, you're having a great time, enjoying the weather if it's nice.
And ideally, our tax exiled as well. That would be fantastic. Please, on a postcard, write to us and tell us all about it.
Pina colada and tax efficient. How about that? Perfect.
Amazing.
Good night, all.
Good night.